Welcome back to FINONOMICS, where we make your money work smarter, safer, and simpler, especially when retirement is already here or just around the corner. Imagine this. You're over 65, you've worked hard your whole life, and now the last thing you want is to watch your savings swing wildly with every market headline. You want peace of mind, steady income to cover bills, healthcare, travel, or just enjoying time with family, without constantly checking your portfolio or worrying about crashes. What if I told you that one of the sharpest investors out there, Kevin O'Leary from Shark Tank, Mr. Wonderful himself, believes in keeping things incredibly simple for people in your stage of life? He often talks about focusing on income you can count on, low costs, and avoiding unnecessary risks. His own mother built serious wealth over decades by sticking to reliable dividend-paying investments that generated cash flow without touching the principal. Kevin's philosophy boils down to this. Dividends are real money you can spend, not just paper gains. He loves investments that pay you to own them, especially in retirement when preserving capital and generating income become the top priorities. And when it comes to easy, low-cost, battle-tested options, he frequently praises Vanguard for their rock-bottom fees, broad diversification, and investor-first approach. Vanguard is owned by its fund shareholders, so they keep costs minimal and returns as high as possible for you. Today, we're revealing the only two Vanguard funds you really need if you're over 65. These are safe, simple, set-it-and-forget-it choices that align perfectly with Kevin's emphasis on income, stability, and not overcomplicating things. They're conservative, with a heavy focus on bonds for steady payouts and enough stocks for some growth and inflation protection, without the roller coaster ride. The first one is the Vanguard Target Retirement Income Fund, ticker VTINX. This fund is literally designed for people who are already retired or very close to it. It maintains a fixed allocation that stays conservative forever. No more gliding toward riskier stocks like younger target date funds do. Right now, it holds roughly 30% in stocks and 70% in bonds. The stock portion gives you exposure to thousands of U.S. and international companies through low-cost index funds, while the bond side includes a mix of government, agency, investment-grade corporate, and inflation-protected securities. This setup provides steady interest income from bonds plus some dividend and growth potential from stocks. Why does this fit Kevin O'Leary's style so well? He always stresses income you can actually use, and this fund delivers through bond yields and stock dividends, currently offering a yield in the 2 to 3% range historically, plus modest total returns around 4 to 6% annually on average over long periods. The expense ratio is incredibly low at just 0.08%. That means if you have $100,000 invested, you're paying only about $80 a year in fees. No hidden costs, no active manager trying to beat the market, and possibly underperforming. This fund has proven itself through tough times. During the 2008 financial crisis, when stocks dropped over 50%, VTINX fell far less, around 15 to 20% at worst, and recovered quickly. In more recent volatile periods like 2022's bear market, it held up much better than pure stock funds. It's diversified across thousands of holdings, so no single company or sector can wreck your savings. Automatic rebalancing keeps everything in line without you lifting a finger. Let's make it real. Suppose you have $500,000 saved. Invested in VTINX, you could expect around $15,000 to $30,000 in annual income from dividends and interest, depending on market conditions, without selling shares and dipping into principal. That's money you can withdraw monthly for living expenses, while the portfolio still has a chance to grow slowly to beat inflation. For retirees, this is huge. Medical costs rise, life expectancy increases, and you need your money to last 20-30 plus years. If you're in India or an NRI looking to access Vanguard, platforms like Interactive Brokers, Vested, or IN Money make it straightforward to invest in U.S. funds like this. Or consider similar Indian options like conservative hybrid funds for a starting point. One retiree I know, a 68-year-old former teacher with about 80 Indian rupees lakh, shifted to a VTINX-style approach. In the tough markets of recent years, his portfolio only dipped 8 to 10% when broader indexes fell 20 to 25%. Now, he pulls steady monthly income without stress, sleeping better at night. That's the power of the first fund. Pure safety with enough income to live comfortably. Now, the second fund takes it a step further while staying true to Kevin's income-first mindset. Vanguard Wellesley Income Fund, ticker VWIAX, Admiral shares. This one's been around since the 1970s, surviving depressions, recessions, wars, and pandemics. It holds about 35 to 40% in high-quality stocks. Think stable, dividend-paying giants like Johnson & Johnson, Procter & Gamble, and other blue chips, and 60 to 65% in bonds, with a focus on investment grade for reliable interest. What makes Wellesley special? It's actively managed by Wellington Management, a trusted partner of Vanguard, but still super low cost at 0.16% expense ratio. The active touch helps select bonds and stocks that prioritize income and lower volatility. It often delivers a higher yield than VTINX, typically 2.5 to 5% or more, because of its focus on dividend stocks and strong fixed income picks. Kevin would love this because dividends are front and center. The stock side is chosen for consistent payouts, and bonds add stability. Historical returns have been solid for its risk level, with less dramatic drops in bad markets. It's not chasing high growth. It's about preserving wealth while paying you regularly. Compare the two. VTINX is more passive and slightly more conservative, perfect if you want ultimate simplicity. Wellesley adds a bit more income potential with light active management. Many retirees split 50 to 50 between them for balance, or go heavier on VTINX if risk aversion is high. How to put it together? Start with your total retirement savings. If you're very conservative, put 70 to 80% in VTINX and the rest in Wellesley. If you want to touch more income, reverse it. Use tax-advantaged accounts where possible to minimize taxes on withdrawals. Follow the 4% rule as a guideline. Withdraw 4% of your portfolio in year one, adjust for inflation after, and these fund stability makes it sustainable. Common mistakes to avoid. Don't chase hot stocks or crypto in retirement. That's gambling with money you can't afford to lose. Don't overtrade. These are buy and hold. Don't ignore inflation. Both funds have some stock exposure to help. And always diversify. Don't put everything in one basket, even great ones. If markets crash, stay the course. These funds are built for it. Bonds cushion the fall, quality stocks recover. Rebalancing happens automatically in VTINX, and Wellesley's managers adjust thoughtfully. At the end of the day, Kevin O'Leary's big lesson for retirees is simple. Make your money work for you through reliable income, keep fees tiny, and don't complicate it. These two Vanguard funds do exactly that. They're safe, they're straightforward, and they've helped millions retire comfortably. If this resonates, drop a like, share with someone over 65 who needs this, and subscribe for more practical money tips. Comment below, which fund are you leaning toward? Or do you already hold one? Let's build wealth together. Stay invested, stay calm, stay wealthy. See you next time on FINONOMICS. Welcome back to FINONOMICS. If you missed part 1, where we dove deep into the first fund, the Vanguard Target Retirement Income Fund, VTINX, go check the link in the description right now. We covered why it's a rock-solid, ultra-simple choice for anyone over 65 who wants maximum safety, steady income, and zero hassle. Today in part 2, we're unlocking the second fund that Kevin O'Leary would absolutely love for retirees, the Vanguard Wellesley Income Fund, ticker VWIAX, Admiral shares. This fund has been a favorite among conservative investors for over 50 years. Since the 1970s, in fact, it has survived every major market crash, recession, and economic storm you could think of, including the 2008 financial crisis, the 2020 pandemic drop, and the volatility we've seen right up through 2025. That's because it's built for one main goal: deliver reliable income while protecting your principal as much as possible. Kevin O'Leary's whole philosophy revolves around real money, meaning dividends and interest you can actually spend without selling your shares, and hoping the market cooperates. Wellesley does exactly that, and it does it better than most options out there. Let's break down why this fund is such a perfect fit for people over 65. As of late 2025, Wellesley holds about 38% in high-quality stocks and 61% in bonds, with a tiny bit in short-term reserves. That stock portion focuses on stable, blue-chip companies that pay consistent dividends. Names like Johnson & Johnson, Merck, JP Morgan Chase, Bank of America, Broadcom, and United Health Group. These aren't flashy growth stocks that swing 20% in a week. They're reliable giants with strong balance sheets and decades of paying and increasing dividends. The bond side is mostly investment grade. Think U.S. government, agency, and high-quality corporate bonds, chosen carefully to provide steady interest payments. The managers at Wellington, Vanguard's longtime partner, actively select these holdings, but they keep things conservative. No junk bonds, no big bets on risky sectors. This active touch helps squeeze out a little extra income and stability compared to purely passive funds. Speaking of income, the current SEC yield is around 3.65% as of November 2025, higher than what most retirees get from bank CDs or basic bond funds right now. That means if you have $500,000 invested, you're looking at roughly $18,000 plus in annual income from dividends and interest alone, before any growth. And historically, this yield has been in the 2.5 to 3.5% range or better, making it great for covering living expenses, health care, or just enjoying retirement without touching your principal. The expense ratio is just 0.16%, super low for an actively managed fund. Compare that to many other options that charge 0.5 to 1% or more. Over time, those fees eat into your returns big time. With Wellesley, more of the money stays in your pocket. Performance-wise, this fund has delivered solid, steady results. As of late 2025 data, year-to-date returns are around 11%, 1 year about 7 to 8%, 5 year around 4 to 5%, and 10 year closer to 6%. Not explosive growth, but that's the point. It's not trying to beat the market. It's trying to protect you from big losses while still growing enough to keep up with inflation. In tough years like 2022, when bonds and stocks both struggled, Wellesley held up better than many balanced funds because of its quality focus. Volatility is low, usually around 1.3% monthly swings, which feels much smoother than pure stock funds. Now, why does this align so perfectly with Kevin O'Leary? Kevin always hammers home that dividends are king. They're cash in your hand, not just unrealized gains on a screen. He loves low volatility, income-generating investments, and he praises Vanguard for their low costs and investor-owned structure. Wellesley is basically a dividend-focused balanced fund with a heavy bond cushion. Kevin's own approach, through his O-Shares ETFs, targets quality dividend payers with stability, exactly the kind of companies Wellesley holds. Let's compare the two funds side by side, so you can see how they complement each other. First, VTINX from Part 1 is more passive and even more conservative, around 30% stocks and 70% bonds, with a tiny expense ratio of about 0.08%. It's a set-it-and-forget-it fund that automatically stays balanced, with built-in global diversification and inflation protection through some TIPS bonds. It's perfect if your top priority is sleeping easy during crashes. Wellesley VWIAX steps it up a notch, slightly more stocks, 38%, active management for better income selection, and a historically higher yield. Many long-term comparisons show Wellesley outperforming VTINX by 1 to 2% annually over decades, especially when dividends are reinvested or withdrawn. For example, in older side-by-side tests, $100,000 in Wellesley grew more and paid out more income than the same in a target income fund, even after withdrawals. But it comes with a tiny bit more volatility, nothing scary, just enough to give you a little extra return potential. So how do you use both? This is where the magic happens for retirees. A simple, powerful strategy is to split your portfolio 50-50 between VTINX and VWIAX. That gives you an overall allocation of roughly 34% stocks and 66% bonds. Super conservative, but with enough equity to help beat inflation over 20 to 30 years. You get the passive simplicity of VTINX plus the higher income and active edge of Wellesley. Or if you're extra cautious, go 70% VTINX and 30% Wellesley for more cushion. If you want maximum income, flip it to 60% Wellesley. Practical tips. Put these in tax-advantaged accounts like IRAs, if possible. Dividends and bond interest are taxed as ordinary income, so sheltering them saves money. Follow a safe withdrawal rate like 3.5 to 4% in the first year, adjust for inflation after. And these fund stability makes it more sustainable. Rebalancing? VTINX handles it automatically. For Wellesley, just check once a year and adjust if the split drifts too far. Real-life example. Imagine a 67-year-old couple with $800,000 in savings. They put 50% in each fund. In a decent year like 2025, they might pull $25,000 to $30,000 in income without selling shares during a dip. During the 2022-style bond/stock wobble, the portfolio drops far less than a stock-heavy one, and recovery happens steadily. They've got peace of mind, monthly checks, and money that lasts. Common pitfalls to avoid in retirement. Don't chase 10% plus returns with risky stocks or crypto. That's for younger folks. Don't panic sell in downturns. These funds are designed to weather storms. Don't ignore fees. Vanguard keeps them tiny, so stick with quality. And always have 6 to 12 months of cash for emergencies so you never have to sell low. If a market crash hits, bonds in both funds act like a shock absorber, high-quality stocks recover, and you keep getting paid. Kevin O'Leary would say, don't be greedy, be consistent. Income is what matters when you're retired. That's the complete picture on the second fund and how these two work together. In Part 3, we'll wrap it all up with a full portfolio blueprint, sample allocations for different savings levels, more Kevin-inspired tips, common mistakes retirees make, and answers to questions you might have. If this is helping you think smarter about your retirement, smash that like button, share it with a friend or family member over 65, and subscribe with notifications on so you don't miss Part 3. Drop a comment. Are you leaning more toward VTINX's safety or Wellesley's extra income? Which one are you considering adding first? Thanks for watching FINONOMICS. We're here to make retirement simple, safe, and successful. Stay invested, stay calm, stay wealthy. See you in the final part.